This morning, Dallas Fed President Robert Kaplan is saying that he's all for a pause with interest rate hikes, at least for the first couple of quarters. And he also said that he's open to discussing the pace, this sort of automatic pace of the Fed pulling $50 billion every single month out of the economy to automatically run off its balance sheet. So is this the way the Fed is sort of offering now, maybe an olive branch, trying to sort of pull things back after that, what many now consider a disastrous FOMC meeting? With me, Nomi Prins. She is the author of Collusion, one of my favorite Fed experts. Yeah, so, Nomi, after the FOMC meeting and the market's violent reaction to it, it got crushed. The next day, we saw New York Fed Chief John Williams come out and try to, maybe calm things down just a little bit. It didn't work. It worked for an hour. After that, the market fell apart again. Do you think maybe this move this morning by Robert Kaplan is some sort of acknowledgement that they have miscommunicated, or maybe they themselves have misread the economic tea leaves?
Yeah, I think it is. And one of the things that we always see with the Fed is that when they're changing the language or the dynamics of their language, they tend to do it with different Fed heads saying things from their respective areas. And that's kind of what we're seeing right now with Robert Kaplan coming out on the back of what John Williams said. And even Jerome Powell, after they hiked rates last month, did kind of walk back this idea of where the normalization rate would be. So even though they went ahead and they hiked rates, they kind of also even started to walk it back. The reality is that volatility happened into that rate hike, after that rate hike, and we're still seeing that.
Yeah, we don't. But see, here's the thing: we don't have the sword of Damocles over our heads. We have the dot plot swinging over our heads. The insistence that no matter what, they're going to hike rates a couple more times and not deviate from this quantitative tightening. Is this something that they should take a serious look at?
I think they should, because what's happening is the whole entire quantitative easing, all of the rate lowering to begin with, did give the markets a lot of stimulus. And so when you take it back without recognizing that things have changed, that there is uncertainty, that there are economic slowdowns in other parts of the world, then you tend to have these massive violent shifts. We saw that when the Fed first raised rates in December 2015, a little prematurely. 2016 opened with the markets really falling out of bed, and we are seeing that again. And so they do need to take a look at more of the data. Let's
talk about motivation. A lot of speculation that President Trump's open disappointment with Jay Powell, the tweeting, the comments over and over again, put Jay Powell in a position where he had to make a decision based on what some consider politics and his own maybe ego rather than what the economic data was. I mean, it's scary to think that could be the deal, but do you think maybe that played a role in their decision?
I really think it did, because, again, we're looking at, weakening in global economies, uncertainty, volatility throughout the market system. And I think he was up against this wall of showing that the Fed could remain independent of what the president was saying, over potentially looking at the byproducts of that rate hike at that time. I think looking at the data would not have presented the exact decision that was made. However, if you add in his desire to show that the Fed could or would remain independent, that's why we got that final rate hike for 2018.
So Jay Powell wasn't going to be punked by President Trump, and then Janet Yellen wasn't going to be punked by Wall Street back in December of 2015. Both times, the next several weeks for the market is almost cataclysmic. Straight down, tremendous volatility, a lot of question marks. This morning, we get the ISM number. Didn't come in as well as people thought. It's still expansion. But we have seen this data, particularly manufacturing data, from several Fed districts, and they have flashed yellow, if not red, flags. When will the Fed take the time to articulate to the investing public that maybe that they have changed their minds? Because Kaplan is good. It's a good start in my mind. He's not a voting member of the FOMC. I think there's a sense of urgency that they do it. Can they use tomorrow's jobs report as that opportunity?
They could absolutely look at it as an opportunity. I think Jerome Powell needs to ultimately be the one to sort of say that, look, we are actively looking at data. He has said throughout this year that he wants to be more communicative rather than less relative to other Fed chair people. And so this would be an opportunity for him to say, look, things are actually slowing down. We're going to take a look at the data. If you want to say that you are an independent body, the best way to do that is actually look at what's happening happening, look at the data, and make decisions based on that.
I hope so. Nomi, thank you very much. Always appreciate it.